Okay, so you now know that there are three stages to the smart money cycle, and each of the cycles are broken down into three individual parts. In this section, you're going to learn how to identify what part or what stage of the cycle you're in, and this will allow you to better align your trades with smart money. So phase one in the smart money trend will unfold at the end of phase three. And this is the first phase of a new trend or continuation. So as we know, we see levels of accumulation which separate each phase. And this is true for both the weekly trend and also the intraday trend. So in terms of the weekly cycle, we looked at phase three, and immediately after phase three was finished, we saw level three accumulation. And this was the extended accumulation that takes place on the weekly cycle, which lasted generally around 2 to 3 days. So the first phase of any trend is going to take place after phase three. And as we saw in terms of the two different ways that market makers will move the trend after three levels of rise or fall, the first phase can be a move in a new trend or the continuation of the previous. Now, the price action preceding phase one will generally be a choppy range bound market and contain an M or W formation, which is typical of phase three price action. And we saw this in our example on the Australian dollar versus the New Zealand dollar. Once we see three levels of rise or fall, again we're going to see that choppy range bound level three accumulation, and from this we're going to see or be waiting for phase one in the new trend or the continuation of the prior. So once you have identified this type of price action, after three levels of rise or fall, a stop run followed by a breakout of the range will identify the first phase of the new trend or continuation. And that is definitely something to remember, because phase one can be one of the most difficult phases to catch. But if you're able to identify and catch phase one of a trend, then you can have a long or short position for an entire cycle. Okay, so as opposed to getting in at the end of phase two and only having one level of rise or fall to trade, if you're able to identify phase one, then you can essentially have a swing trade and trade for one complete weekly cycle. So once you've identified level three price action, which is the accumulation of orders over a period of 2 to 3 days, and we see the W or M formation, which is a characteristic of phase of level 3 price action, we're then going to be looking for a breakout of the range to identify the first phase of the new trend or continuation. So in this example on sterling against the dollar, we're looking at the 1 hour chart and we're looking at the weekly cycle. So we can see that we've had day three, and we've had three levels of fall, and after we see three levels of rise or fall, we're going to expect the market to go into level three accumulation, and we see this take place over the course of 3 days. And here, as we know by now, the large institutions are accumulating their positions for the next phase or the next move within the weekly cycle. Now, the first phase is going to come out of level 3. Okay, because we know that the smart money cycle goes from stage or phase 1, phase 2, phase 3, and then back to phase 1. So how do we know when level 3 accumulation is over and the first phase of the new trend or continuation is underway? Well, we're going to be looking for a break of the range. So we have a level of resistance, which is the high of the accumulation zone, and we have a level of support. Now, once we see price action break and trade beyond our zone, whether that be the support or the resistance, and the market meets its typical ADR, we're going to consider this phase 1. So in this example, we can clearly see that the support of the level 3 accumulation range has been broken, and the market has traded down and then traded into the following day below the accumulation zone. So phase 1 is probably the most difficult to identify and catch, but if you remember the simple rule that you're looking for a break beyond the high or low of the level 3 accumulation zone, you want to confirm that by looking at the range of the move and asking yourself, does it meet the average daily range for the recent price behavior within the pair? And then you're going to consider this your phase 1. In the second example, we're looking at the euro dollar, and we can clearly see that we have had 3 levels of rise over the course of 3 days. And as we know by now, with both the intraday and also the weekly cycle, once we've seen 3 levels of rise or fall, we're going to expect the market to go into accumulation. And we can see that level 3 accumulation occurred over the course of 2 days. Now, as stated before, in the behavior and characteristic of a typical level 3 accumulation zone, you're generally going to see price action take the form of an M or a W. And we can see this in the price action during this accumulation zone. And the purpose for this is that the structure within itself is a stop run. Okay, so before each level of rise or fall, whether this be during the intraday cycle or during the weekly cycle, we're going to expect a level of rise, accumulation, and then a stop run. So during the level 3 accumulation zone, we have this level of resistance set, and then notice how smart money trade within this range, and then they break their resistance zone. And this bar here at one point would have been all green, and this would have induced the retail traders, the breakout traders, and the support and resistance traders to begin buying into this market, allowing smart money to sell into this pressure and then move the market down. And as we see, the price breaks the range of the level 3 accumulation zone and closes well below it. So again, once we see this stop run and break of the range, we're going to consider this our phase 1 or our first leg of our new trend. Now, one thing to note is phase 1 can be difficult to identify and trade, especially for new traders who are new to the strategy. Trading this phase of the weekly trend should only be attempted once you have sufficient experience and confidence in identifying the smart money cycle. Okay, so of all of the 3 phases or legs of the weekly cycle, identifying and trading phase 1 you will find most challenging, and this is because it's the initial stage in the trend. With both phase 2 and phase 3 of the trend, you already have an inkling as to the direction, because you already have a movement in a particular direction. So for example, if you're going to trade phase 2, you already have a directional bias from the direction of phase 1, and by the time you get to phase 3, you will already have had 2 directional moves over the course of 2 days in one particular direction. So your bias will be pretty much set. Now for phase 1, because you're coming out of an accumulation zone, and you also have the stop run that induces traders in the wrong direction, identifying phase 1 can be challenging, but give it time. And again, with experience, and as you begin to get used to understanding and reading the cycle, and with the whole strategy in general, you'll soon find that you'll be picking out these levels quickly and easily. Now there is one tool and a strategy that can help in assisting when trying to identify this level, and this is called currency correlation. And it's something that we're going to go over later on in the course, but it's a great tool that would assist you in identifying phase 1 of a weekly trend. So once we've identified phase 1 coming out of level 3 accumulation, we're going to be expecting the second phase or the second leg of the weekly cycle to be in the same direction. Now in terms of phase 2 is the simplest to trade, and this is simply because once phase 1 completes, it identifies smart money's trend direction. Now as we know, the smart money trend moves in 3 waves, so once phase 1 completes, we should be expecting 2 more moves to the longer term low or to the longer term high, depending on whether it's a bullish or bearish phase 1. So once level 1 has formed and the market's price action has returned back into accumulation, the following day we wait for the stops to be triggered in line with the trend's direction. So if the identified trend, which would be phase 1, is identified as being up, on the 15-minute chart we would look for signs of manipulation of retail sellers, such as manipulation below the Asian range. Okay, on the flip side, if the trend is identified as being down, on the 15-minute chart we're going to look for manipulation of retail buyers, such as manipulation above the Asian range. Okay, so if you just think about the process in a logical step-by-step manner, we have looked on our hourly chart and we have identified that the first phase of the new trend is to the downside. So the following day we're going to be looking for manipulation of buyers, and this is because we're going to be expecting a second move to the downside. So we know that smart money are going to be accumulating sell orders, and then they're going to manipulate buyers into the market so that they can sell into the buying pressure, and then ultimately begin the second phase of the market trend to the downside. And the reverse is true to the upside. Now, during the manipulation phase, price action will form a reversal candlestick pattern. And candlestick patterns, as you will learn, are our key to deciphering and identifying if manipulation has taken place at any one level. Okay, so during the manipulation process, we're going to be looking for reversal candlestick patterns or M and W formations. Now, the pattern that generally occurs will depend on how much volume is available and how much smart money needs to accumulate. So in the case of M and W formations, you would generally find that smart money are accumulating more orders and manipulating more orders as opposed to just normal candlestick patterns. But we don't need to go into that now, because we're going to have a full section on these two manipulation processes. But for now, we're just going to take a look at how we would identify which level of manipulation to expect once we've identified phase 1 price action out of level 3 accumulation. So in this first example, we're looking at the euro sterling, where we have identified level 3 accumulation after 3 days of fall. In this case, we can see that the level of support set during the accumulation stage is broken by smart money, performing a stop run, and this, as we know by now, would bring in an influx of selling from retail traders that smart money will then buy into and cause phase 1. So this occurs on the 7th of July. So the following day, on the 8th of July, we're going to be expecting our phase 2. So if we go to our 15-minute chart, and we can see here phase 1 of the 7th, and we can see that the market has gone into a period of accumulation for the next day. And straight away, because we understand and we have identified the direction of phase 1, our bias as to what smart money will be accumulating during the Japanese session would be buy orders. Okay, because we know that the market is moved in 3 phases. We've identified phase 1. We're looking to trade in line with the market maker trend in phase 2. So our directional bias should be to the buy side. So if we're expecting smart money to move the market to the upside to complete phase 2, then we know that during the manipulation process, they're going to induce retail traders to sell. Okay, so we're going to be expecting smart money to induce retail traders into the wrong side of the market, which would be the sell side, so that they can buy into these orders and complete phase 2. So if smart money are planning to absorb orders from retail traders who are selling into the market, where is it likely that retail traders are going to begin selling? Okay, well, as we know, support and resistance levels, along with other technical levels such as Fibonacci and pivot points, are all areas which, once broken, retail traders are taught to place their orders and also getting to the market. So if we start by looking for levels of support, so these will be levels below the range of the Japanese session, we're going to mark these levels off, and these will provide us with high probability areas that retail traders will build up orders or enter the market on the sell side and allow smart money to absorb their order. So we'll start with the first, which is the most obvious, which is the low of the Japanese session on the current day. Okay, so this is the current day, the 8th of July, that we're looking for our manipulation to take place to the downside. So we're going to mark off the Japanese low. What's interesting to point out, if we look at the 4th of July, which is 2 trading sessions previous, we can see that the low of the current day's Japanese session aligns with the high of the Japanese session of 2 sessions ago. And again, this goes to highlight the fact that many of these support and resistance levels that smart money would use to manipulate the market would align with support and resistance levels of previous sessions. Now, the second most obvious level of support will be the high of the previous day's Japanese session, and we can see this level clearly marked here. Now, what we would expect is smart money at the beginning of the London session, where we know that the manipulation and trend takes place, to artificially move prices below the support levels. And once these support levels are broken, they will induce the traders into the wrong side of the market. Now, if smart money break the first level and there is not enough volume for them to accumulate, or not enough retail traders are induced into the market, many times the retail traders that are there hesitating to get into the market will need more convincing. So all smart money will do is that they will bring the market down further and break another level of support. Now, what adds weight to these levels is if we see another technical level align with one of these levels. So just for interest's sake, we will take the Fibonacci retracement tool, and we will go from yesterday's low up until yesterday's high. Okay, and just by doing this, we can see that the 0.382 internal retracement of the previous day's high and low has aligned with our first support level, which is the low of the Japanese session. And then we can see that the 0.618 internal retracement falls within a relatively narrow price range to the second support level, which is the Japanese high. So in and around these levels, we would expect to see manipulation and the absorption of retail orders. So we would have these levels marked off before the London session opens. So that would give us enough time to wait for the levels to come into play, and then to identify the manipulation take place, and then to buy into the market in line with the market trend. So if we move the market on, we can see that smart money are beginning to push the price down into our first identified level, and then we can see that they've gone through this level, and there we have the move. So if I just move the market on, we can see that smart money at the end of the Japanese session aggressively pushed prices down. There was a slight hesitation at the first level, and I'm just going to zoom in here so we can see this more clearly. We can see that there was an initial hesitation at the first level, where some of the retail orders that were coming into the market were absorbed, and we can see evidence of this in the buy-in here. But evidently there wasn't enough volume at these levels, so smart money pushed the market down further. Now, if you notice this bar here, which we refer to by many fancy names, at one point this whole bar would have been red. Okay, so at one point this whole pin that makes up the majority of this bar would have been red. Now, as the selling pressure from retail traders is absorbed and the overwhelming buying of smart money comes into the market, this bar is ultimately pushed up as the retail orders are absorbed, and then the trend in the direction that we had expected from the previous day, which is to the upside, is unfolded. Okay, so by identifying the direction of phase one, the following day we're going to be looking for manipulation levels in line with the direction of phase one. And once we've identified and interpreted the manipulation to have taken place, we will then buy or sell into the market. In this case, we would have bought, and we would have been in line with the intraday and also the smart money weekly trend. In the second example, we're looking at the US dollar versus the Canadian dollar. Now, on the 1 hour chart, we can see that we have a clear level 3 accumulation cycle which has spanned the course of around 3 days. Now, just to go over the process, we're first going to be looking for manipulation to take place during the level 3 accumulation stage. This will then unfold our phase 1 of the smart money weekly cycle, and once we have the direction of phase 1, we're going to be looking on our 15-minute chart to trade in line with the smart money trend. So during the accumulation process, we have that M formation, which is typical of level 3 accumulation. We also have a stop run candle which breaks the resistance level, and again at one point this bar would have been entirely green, but as smart money begin to sell into this buying pressure because of the break of the resistance, we see that the bar gets pushed right down, and then the market ultimately breaks through the range and develops phase 1 of the market maker cycle. So on the following day, we'll be looking for phase 2 in the direction of phase 1. So we'll be looking for a trade to the downside. So we would be flicking over to our 15-minute chart, and because we have identified a bearish phase 1 during the Asian session for the current trading day, we will be assuming that during the accumulation process, smart money are going to be accumulating sell orders. Okay, because we're expecting a second move down to complete part of the smart money cycle. So during the accumulation process, during the Asian session, we're going to be expecting smart money to be accumulating sell orders. Now, if this is the case, where is manipulation going to take place? To the up or to the downside? Well, if they're accumulating sell orders, we know that during the London session, it's highly likely that they're going to induce traders into the wrong side of the market, which will be the upside, and they will be looking to create the illusion to retail traders that the market is going to be in a bull trend to buy into the market, and then smart money will quickly sell into this buying pressure, push the market down and complete phase 2. So we're going to be looking for levels where smart money are going to induce traders to buy, and we know that most retail traders are taught to buy or leave their stop loss or pending orders in and around support and resistance levels and daily technical levels. So immediately we're going to mark off the current day's Japanese session highs, because this is a prominent level of resistance that many retail traders will be watching. And then we're going to look for other obvious points of resistance, which once broken will induce retail traders to buy into the market. So the second most obvious point is the previous day US high. We'll mark that point off. And then we have another level which isn't as obvious, but we can see that we have a touch of this level here, and it also coincides with the low of the previous day's Japanese session. So we have three levels of resistance which most traders will be aware of and have marked off on their charts. And as we saw in the last example, if we wanted to reinforce these levels, we could add some Fibonacci internal retracements or any other technical levels, and we will add these from the previous day's high to the previous day's low. And what we're going to be looking for is for these levels to overlap or fall within a relatively narrow price range to our horizontal support and resistance levels. And we can see that the 50% internal retracement has overlapped our second level of resistance, and the same is true with the 0.382 internal retracement. This has overlapped with the Japanese high. So what you have to think about is traders will always use levels of some sort. So even those traders who don't use horizontal support and resistance levels may use fibs. And if they're using fibs, it's not a coincidence that the levels overlap with the horizontal support and resistance levels. So whatever you use, you're still going to be getting in and hoarding your orders in and around the same levels as other retail traders using different strategies. And this highlights how effective the smart money strategy is in combating and beating the various strategies used by retail traders. Okay, so from this point, what we'll be looking for is we'll be looking for, during the London session, a break of the resistance levels. And once we see a break of a particular resistance level and we interpret manipulation, we would then be selling into this market in line with the smart money trend for the completion of phase 2. So we'll move the market on, and here comes the London session, and we have broken the first level of resistance, and we can see that the bar at one point would have been all green, but selling pressure has come into the market, and we have evidence of smart money beginning to sell into this buying pressure. Okay, and there we go from there. So if I just zoom in so we can see this a bit more clearly, we had smart money push the market up after the open of the London session, and we saw evidence of selling coming into the market, and we can see this in the bar represented here. There obviously wasn't enough volume accumulated at this level, so smart money made a second pass and then entered into the second resistance zone that we had identified, which contained a horizontal support and resistance level, which aligned with the previous day's Japanese low, and also the 50% internal retracement. And from this point, a large amount of buy orders came into the market, allowing smart money to aggressively sell into this market, which is represented by these two red bars. and then ultimately we saw the market begin to move to the downside, and we can see that during the American or US session that phase 2 was completed. So by identifying phase 1, it gives us a strong bias as to the direction of phase 2, and it allows us to pick levels of manipulation well in advance of the market actually reaching these levels. Now, a few things to keep in mind in regards to the manipulation levels and also the manipulation process, and that is, once smart money have executed a stop run, it is very rare they will perform another stop run at the same manipulation point. Okay, so once we have identified phase 1 and we have identified our levels for phase 2 where manipulation is highly likely to take place, once we've seen a stop run or an M formation at one of these levels, it's very rare that another stop run will be performed at the same point. Now, this does happen sometimes, but this will generally only occur if there is another build-up of retail orders that smart money can benefit from, or if the initial required volume to enter or exit positions has not been achieved. And it's exactly the same concept with the levels that we identify. There'll be many times, and we will look at this in our section on identifying manipulation points, but there'll be many times, as we saw in examples, that you will have multiple areas where smart money may choose to manipulate the market. Now, if they come into a level and there is not enough retail orders coming into the market and they don't have the required volume, again, they may need to convince retail traders that the market is moving in a particular direction. And as we know, this direction is usually in the opposite direction to where they intend to move the trend, and we will see that they will move the market into other levels of support or resistance. And this is true with stop losses, stop runs, and also the M&W formations. If they perform a stop run at a particular level, they may come away from this level, wait for another build-up of orders in and around the same level, whether this be stop losses or pending orders, and once they see another build-up, they may make a second pass at the level. But it's very rare that they do this, and it's a great advantage to us knowing this, because once we are in a position and we've identified the manipulation process, placing our stop in and around the level of manipulation gives us a good amount of insurance that our stop losses will be safe from being hit. Because once we've entered the trade in line with smart money and we've placed the stop loss at the manipulation point, it's very rare for them to come back to this manipulation point and perform another stop run. And in some cases, they will make a third pass at a level, which is commonly referred to as a head and shoulders pattern. But more on this later. So on to phase 3. So once we have identified two levels of rise or fall within a currency pair, phase 3 should be expected. Now, it's very important to check whether the average weekly range for the pair has been met. And I can't stress how important that is, because although we have looked at many examples of the intraday and also the weekly cycle unfolding in 3 legs or 3 phases, as stated in the beginning, the trend can last for just 2 days. Now, this occurs when we have overextended markets or volatile markets, and the weekly range, which is usually panned out over 3 days, occurs within two. So once you've seen two levels of rise or fall, check to see whether the average weekly range has been met. Now, if it has been met, then we may be looking towards a level 3 accumulation style behavior within price action, and then we'll be looking for the continuation or the reversal of the previous trend. Now, if you measure the two phases and it hasn't met the average weekly range, then we're going to be expecting a third level of rise or fall. Now, in terms of trading phase 3, we're going to be using the same strategy that we used to trade phase 2. So there's no difference in the way we're going to identify levels. When trading the last leg of a trend, we have two directional moves behind us, so it adds even more weight to the expected direction, and we're simply going to look for levels manipulation in line with the two phases that have already unfolded, and then trade accordingly. So we'll have a look at an example of trading phase 3. So in this example, we're looking at the US dollar versus the Canadian dollar, and we have identified two bullish phases. We have phase 1 to the upside, and then we have a second phase or leg to the upside. So in regards to trading in line with the market maker trend on day 3, we're going to use the exact same strategy that we did to trade the phase 2, and we're going to drop down to our 15-minute intraday chart, and then on the third day we're simply going to look for our manipulation points where retail traders will be induced to sell the market. Okay, so we're going to be looking for areas where smart money are going to induce retail traders to sell into the market, so again they can buy into this selling pressure and finish the 3-day cycle. So on day 3, we're going to mark out our levels of support. So the first will be the most obvious, which is the low of the current day's Japanese session, and then we're going to look for other levels of support and resistance, and we can see we have a level of resistance at this point, and then we're going to add Fibonacci ratios to reinforce these levels. And in this case, we can see that we have an overlap of our second support zone with the 50%, but there's no overlap with the low of the Japanese session. So we're simply going to looking for a move below one of our levels of support, which will induce retail traders into the wrong side of the market, allowing smart money to buy into this pressure. So we'll move the market on, and we can see an initial break of our first level of support, which will induce traders into the wrong side of the market, and then we can see the third day to the upside unfold. So no different to trading the phase 2. We're simply looking for levels which will induce the retail traders into the wrong side of the market during the accumulation process during the Japanese session. We'll be expecting smart money to be accumulating buy orders. We can see the stop run formation take place where the retail orders have been absorbed, and then ultimately the market moves to the upside, completing the 3-day cycle. So very simple and very straightforward. We're simply going to be looking for manipulation levels in line with the previous 2 days cycle. So as we know, phase 3 is the last phase of the smart money trend, and it will typically produce choppy and erratic price action, which by now we know as level 3 accumulation. Now, phase 3 is where smart money will liquidate the majority of their accumulated position at the highest or lowest part of their cycle. So we saw this when we looked at the intraday cycle, that after the third leg, generally during the US session, the liquidation of the majority of the smart money position would take place, and this would cause the market to turn or go into sideways consolidation. And the same is true for the weekly cycle. Once smart money have reached the third phase of the cycle, the majority of their position will be liquidated. Okay, and retail traders who were forced out of the trend early and those who missed the first two phases of the trend pile into the market at the worst possible point and become trapped. Now, what does that mean? Well, because we know that 95% of retail traders are on the wrong side of the market, by the time they join a cycle and they are in line with the smart money trend, it's generally about the time that smart money are going to change direction. So if you can imagine a trader who was in phase 1 and got manipulated out of the market, may have then tried again at the beginning of phase 2 and again got manipulated out of the market. By the time they get to phase 3, they have seen 3 levels of rise, or they've seen a substantial bull or bear market, and those who were hesitant and those who have been manipulated out of the market will want to get into the established trend. So smart money are aware of this, and they will generally see an influx of orders into the market which will allow them to liquidate their position. And this process, as we have seen, will generally take place over the course of 2 to 3 days. So smart money will then begin the longer term accumulation process, which, as I said, can last 2 to 3 days. Now, during this 2 to 3 day range bound market, smart money gives time for retail traders who have taken a financial hit to take a break and return to the market. So those traders who have been beaten up, as it were, throughout the cycle, they generally will sit back. And for any of you that have traded, once you have taken a hit, you either enter the market very quickly and the same thing happens, or you take a break. Now, for those traders who need that break to reassess their strategy or reassess their psychological state, smart money allow them this time, and this is why they have this period of liquidating their position over 2 to 3 days and calm the market down, giving the traders who have taken a hit to return to the market. Now, what will happen is the range, or the level 3 accumulation range, will create visible support and resistance levels, and we've seen evidence of this time and time again. So what do the retail traders do? They will build orders on either side of the zone. Okay, so level 3 is for the liquidation of the majority of the smart money's accumulated position. It's also created to allow traders who have taken a hit in the market to return to the market, and in doing so, by creating a visible 2 to 3 day support and resistance level, it allows the build up of retail orders. So once smart money begin to see these orders build up around this 2 to 3 day accumulation zone, a move against their intended direction and a stop hunt in the form of an MLW formation spread over the course of 2 to 3 days will absorb the required volume before the start of a reversal or continuation of the new trend. So it is the exact same process but on a larger scale. So they build a 2 to 3 day support and resistance zone where they're accumulating and liquidating positions. They will then move the market against their intended direction, absorb further orders from retail traders, and then begin the new cycle. Okay, so level 3 price action is range bound and has no clear direction. So during a cycle, we know that we're either going to have a bullish cycle or a bearish cycle. But with level 3, because we're trading within a range, there is no clear direction. So because of this fact, we will look to identify potential manipulation areas on both sides of the range. And until the range is broken and phase 1 of the new trend or reversal is clearly identified. So all that means is because we don't have any clue as to what smart money are accumulating, whether it's buy or sell orders, and we don't know whether they're going to reverse the prior trend or if they're going to continue the prior trend. For us to successfully trade phase 1 out of level 3 accumulation, we're going to look to identify manipulation levels on both sides of the range. So for example, if we have a resistance area during level 3 accumulation which is broken and we see manipulation taking place to the buy side, then we can rest assured with a high degree of probability that phase 1 out of level accumulation will be bearish, because if they're manipulating orders to the upside and breaking through resistance, we want to see evidence of selling pressure coming into the market. We can sell into this pressure along with smart money and trade the first phase of the new or continued trend. Okay, so after 3 levels of rise or fall, we're going to expect to see level 3 accumulation, where smart money are going to liquidate the majority of their position and then proceed to accumulate new orders for the continuation or reversal of the prior trend. Now, in this example, we had 3 clear levels of fall to the downside, and then we have this period of accumulation take place. Now, in terms of the range which is set, it's much similar to how the Japanese session works on a day-to-day basis. So we have a period of sideways price action, and then we have the high of the range set here. Okay, so we have the market come down, go into sideways accumulation, trade up, and then bounce down, which sets our level of resistance. The market then continues to trade down, and we see a level of support established leading into the second day of accumulation. So once we have both the high of the accumulation range set, we have a level of resistance, and we have an established low, we now have a level of support. So leading in to day 2 or day 3, however long the accumulation takes place, we'll be looking to trade the manipulation on both sides of the market, because we have no idea as to what the intention of smart money is during this accumulation process. And just like with the intraday, only a manipulation to either side of the range is going to give us a clue as to what it is they are accumulating. Okay, so on day 2 of the accumulation process, we see a break of the support level, which is our stop run candle, and then notice how the market turns and we have these aggressive bars to the upside as smart money absorbs the selling of retail orders on the break of the support level. Okay, so during this process where we have no cycle to give us a clue as to the direction of the market, we're going to be looking for manipulation on both sides. And once we see manipulation of the support or resistance level, we will then buy or sell into the market and be able to catch phase one. Now, one thing I do want to point out is this level here looks like a manipulation point, and to a certain extent it is, because we see here that we have two bars which have caused a high, and then smart money have broken this level with a pin which is aggressively sold to the downside. But one thing to keep in mind is that level 3 accumulation would tend to take place over 2 to 3 days. Now, if we look at the accumulation process here, this is all takes place within 1 day. Okay, so we need that day or two, depending on how long the accumulation process will take place, to set a high and a low for the range. Now on day 2, which is the minimum requirement for the accumulation process, we're going to see manipulation take place, in this case to the downside, the absorption of retail orders, and then the first phase of the new cycle. So in this next example, we're looking at the Australian dollar versus the New Zealand dollar. Now, as a retail trader, if you've turned your charts on and you've seen this move to the upside, your first instinct is to go long. As a retail trader, whether you are reading or whether you are attending seminars or physical classes, one of the first things that is drummed into your head is to trade with the trend. Now, without having an understanding as to the smart money cycle, not only can you get into a trend at the wrong point and be manipulated out of the market, but if you join a trend at the end of a cycle, it can be one of the most costly practices within all of trading. Because if you have a large stop, for example, and you enter a trade within level 3 accumulation on the wrong side of the market, you are going to have 3 cycles of a counter directional move against your position. So understanding where you are in the market in terms of the smart money trend is essential to trading successfully within the Forex market. So we've seen 3 levels of rise, and then we would expect to see our level 3 accumulation. And in this example, we see that we have a high which has been established, and then we have a low which has also been established, and then we have 1, 2, 3 days of accumulation. So we would mark out the high and low of the range. We have a high set here, and then we also have the low. Now notice how smart money trade within this range but never break it. Okay, we can see price action trading up and down but not breaking the range. So again, because we have no idea as to what they intend to do with the market trend or what they're accumulating throughout this accumulation process, we're going to need manipulation of one side of the range to let us know what side of the market is the high probability directional move of the next trend. Okay, so we're going to be trading both sides of the market, or looking for manipulation on both sides of the market to give us that clue. So if we move the market on, we can see that smart money break the resistance area of the zone, and as we know, this would induce buyers into the market. Those who sold throughout the range will have buy stops above this resistance zone, so those orders will also be absorbed, and then smart money bring the market up to a point, and then ultimately the market begins to fall. Now, what's interesting is not only do we have the classic M formation, which I promise we will go into, but let's look at the level that they chose to manipulate. So if I look at the manipulation point, we have a level of 104.02. So 104.02 we can see has been traded through twice. Now I'll get rid of the lower level. Now, why have smart money chosen to manipulate the market at this point? Well, as before, they will generally drive prices into previous levels of support and resistance. Now, in this case, we're looking at manipulation taking place on the 29th of July. Okay, so they've run prices up out of the level 3 accumulation zone on the 29th of July. So if we go to the daily chart, which gives us a wider view as to what price action has done, we can see that the last time the same level of 104.02 was hit was back on the 12th of December. So we're talking some 7 months ago that this level was hit. But smart money will be aware that although it took place a very long time ago, retail traders will be watching this level, and this allowed smart money to take advantage of this fact and absorb the orders for the retail trader. So going back to the hourly chart, once we see the break of the resistance zone, we have a high degree of probability that the trend that the smart money are going to run over the next 2 to 3 day cycle will be to the downside. So identifying phase 3 accumulation. Now, if you're looking at the 1 hour chart and you can't figure out a clear trend direction and price action is choppy, it's highly likely you are in phase 3. Okay, so when you're looking at your 1 hour chart, which is the chart we use to identify what phase of the smart money cycle that we are in, if the price action is sideways, choppy, consolidating, whatever you want to call it, it's highly likely that you are in phase 3 accumulation. And the best way to clear up if you are in this phase is to look back 2 or 3 days and see if there is a clear cycle. Okay, another thing that will help in identifying phase 3 accumulation is the identification of the M or W formation over the course to 2 to 3 days. Okay, so again, if you identify within price action an M or W formation over the course of 2 to 3 days, then count backwards and look for cycle. So the price behavior of level 3 accumulation is typically non-directional and will span the course of 2 to 3 days. A very useful tool for identifying level 3 accumulation are moving averages. Now, by plotting two shorter term moving averages, which will effectively measure the short-term price trend of the market as opposed to the longer-term market trend, we will see multiple crossovers and a very narrow angle and separation between the two. Now, my preference has always been the 5 and the 13 exponential moving averages. Now, this will be down to your own experimentation, but if you take a look at plotting two shorter term moving averages, you will notice that during the 3-stage cycle leading into level 3 accumulation, that you will have very few crossovers, and the angle and separation between the two moving averages will be a lot wider. But because we enter into a period of sideways non-directional price action, this causes the two moving averages to become very narrow and cross multiple times, and this is a great indication to you as to whether the price action or the smart money cycle is in level 3 accumulation. So once we see this behavior within the moving averages, you should always ask yourself, has there been 3 levels of rise or fall? So once you witness this narrow separation and multiple crossing of the moving averages, we're going to count backwards and we're going to look to see if there are 3 levels of rise or fall. And also, if we have witnessed this after just 2 levels of rise or fall, we're going to want to check the average weekly range of the market in which we are trading, because if we see this behavior and we look back and there are only 2 levels of rise or fall, we may expect a 3rd level to unfold. But if we check the average weekly range, which you have already been taught, we may find that the level 3 accumulation process is actually underway, and then we should expect either a reversal or a continuation of the prior trend. So in this example of the Australian dollar versus the New Zealand dollar that we looked at, we had 3 levels of rise, and I've plotted both the 13 and the 5 moving averages. Now, the 5 moving averages is represented by the blue line, and the 13 is represented by the 13. Now, just notice the separation between the 2 moving averages. So as the market is trending and it has a directional bias, in this case to the upside, we can see a nice separation between the 2 moving averages. Now, in terms of the crossovers, we have a crossover here, we have one here also. So we have 2 crossovers leading up into the 3rd day of the cycle. Now, as smart money begin to accumulate positions in level 3 accumulation, look at the behavior of the moving averages. So we have across here, we have another cross, 4, 5, 6. So we have a total of 8 crosses. Okay, so the separation between the 2 moving averages at some point is almost non-existent, but overall the separation is very narrow. So 2 characteristics of a moving average, the 5 and 13 in this case, can give you a great indication as to whether you are in level 3 accumulation. The 2 characteristics you're going to be looking for are multiple crossovers of the moving averages and also narrow overlapping separation between the 2 lines.